guys, welcome back to Critic Champions. This channel is totally unbiased and just based on my real experience, and I did the research. You don't have to. Okay, so of course this research is based on data. So let's get started. And today I'm gonna share about like luxury versus the S&P 500. Is your closet a smarter investment in 2026? Let's get started. If you put $10,000 into S&P 500 10 years ago, you'd be sitting on a fortune today. But if you put that same money into a rare Patek Philippe, you might be sitting on even more. In 2026, we have to ask the hard question: is luxury actually a viable part of diversified portfolio, or it's just a distraction from real wealth? So according to the 2025 Knight Frank Wealth Report, certain luxury assets have grown 72.6% in a decade. But the S&P 500 just finished a massive 3-year run. Today, we are looking at the legit data to see if your collection is actually worth the money all the time. Okay, let's get real about the S&P 500. Over the last decade, the index has returned on average 13.5% annually, excluding dividends. If you include dividends, that jumps to a staggering like a 15.5% compounded annual growth. And to put that in perspective, S&P 500 10 years total returns approximately 323%. Luxury watches 10-year total returns is approximately 125.1%, and handbags 10-year total return approximately 70%. So, if stocks are crushing luxury, why even bother with a collection? Because of volatility. The S&P 500 saw a nearly 19% decline in early 2025 before rebounding. And luxury assets, particularly investment-grade bags and watches, tend to have lower volatility. They are hard assets that don't vanish if a tech bubble pops. And as a stock investor, I love the S&P 500 for my core wealth. But any professional advisor will tell you diversification is the only free lunch. Luxury acts as an alternative asset class. So when the stock market gets too concentrated, like in 2025 when just 7 tech stocks accounted for over 50% of the S&P 500's gains, your risk is high. And luxury assets are a store of value. While they might not provide the 15% annual compounding of a bull market, they also don't usually see the 20% overnight corrections that stocks do. They are your insurance policy you can wear. So let's apply to our motto. Was it worth the money? If you are looking for the absolute highest return, the S&P 500 is your best bet. But if you want a tangible asset that protects your capital during a market crash, luxury wins. Was it worth the time? Well, this is where it gets tricky. Buying an S&P 500 ETF takes like 30 seconds. Getting a quarterback at Hermes can take 30 months of relationship building. If you don't enjoy the culture, the time cost of luxury is too high. So my verdict for 2026 is use your stocks to get rich and use your luxury assets to stay rich, okay? A 5% allocations into high conviction luxury pieces is a brilliant way to diversify a stock heavy portfolio. The data doesn't lie, okay? So stocks are for growth, but luxury is for legacy. So Which one are you betting on this year? Let me know in the comments below. I put the links to the 2026 market report and the S&P 500 performance data in the description so you can do your own research. Until next time, invest with your head, but maybe keep a little on your wrist. Alright, if you found this video helpful, please subscribe and share it to your friends or your family who might benefit from my insights. Until next time, bye bye.